What's up, everybody? Good afternoon. Hope today's treating you well. Tomas Patterson here with Boss Financial, and today just a quick little video related to a series, the dividend investing series, because you know I absolutely love my dividends. I love the cash flow, and the majority of my strategy is to invest in dividend yielding stocks because I love the truly passive income, as well as I'm only 23, so I want these dividends to start to build now and compound as much and as soon as possible. So I thought it'd be a good idea to help share some of these thoughts, these ideas, these strategies with my viewers. That way you can take advantage of the same things that I am, and it's going to help to be transparent in that sort of sense. Today I'm going to cover the all famous REITs, okay? I'm going to go over what they are, what's important about them, why they might be important to you with the benefits they offer, and also what to look out for. And at the end of the video, you should have a clear understanding of REITs, and you should have all the knowledge you need to actually go out there and start investing in REITs yourself if that fits into your portfolio or your strategy. So yeah, make sure you give a thumbs up if you enjoy this video. It means a lot to me. Smash that subscribe button, just smash it, okay? And yeah, let's get into it. So what a REIT actually stands for is a real estate investment trust. So this is a trust, okay? So that's a legal entity that's generally a three-way relationship, okay? And the purpose of a trust is to properly pass on money or other assets in any particular arrangement. So a trustor would give a trustee the authority or the right to hold title to property or assets on behalf of a beneficiary, okay? And in the case of REITs, the property we're talking about here is, well, property, okay? Real estate. So the trust owns a portfolio of REIT eligible properties. So these are usually large things like office buildings, commercial properties, shopping centers, apartment complexes, things that are big and generally have stable tenants and longer contracts. REITs can be publicly traded, which means that you can find them on the stock market, and they're as easy to buy as a normal stock is, okay? They each have their own ticker symbol, and you buy units of them, and they each have their own portfolio of properties. So REITs can actually make a strong addition to your portfolio, okay? REITs give you the amazing benefit of being able to invest in the real estate market without actually being physically involved, okay? So you have minimal risk as well as minimal work, but you can still get great returns on your money. As they include a portfolio of properties, investing in REITs gives you the opportunity to have diversification in your portfolio, okay? Meaning that you don't have to put all your eggs in one basket. When you invest into one REIT, you're getting exposure with all their properties. These real estate investment trusts pay out the majority of their income every month to unit holders. So essentially, you're getting a small percentage of all the rental income on a regular basis just for owning these REITs. So if you're having a hard time understanding why this is so important, imagine if you saved up a bunch of money to put towards a down payment on a house that you wanted to rent out. You would cough up this money for the down payment, and then you're likely going to take out a mortgage for the rest of the principal remaining on the house, let's say for 25 years. You also might have some renovations you have to do, okay? Maybe some repairs that are immediate or even recurring to maintain the integrity of the house. But then you also have to worry about things like taxes and regulation. All these things you have to deal with create some legwork, okay? And they're going to eat into your income and your returns in the short term. You could even end up losing money. And keep in mind, this is all before we consider the important stuff, okay? That's finding tenants, removing bad tenants, having vacancies while you're looking for more tenants, crunching numbers, all that fun stuff. So if you would rather be a more passive investor, you'd rather have people manage your money for you, let your money do the work over time with little involvement, then a REIT's going to be a good choice for you because you collect this rental income in your sleep, okay? So it's on a constant, regular basis, and you're able to play in a whole new section of the real estate market that for the most part, it's pretty stable. And the best part is you're getting a return on your money dollar for dollar. A lot of investors, including myself, they invest in REITs due to a few reasons. Generally, though, the most important is because of the dividends. If you're a dividend lover, okay, if you love these cash payments coming in regularly, then you might want to consider adding some REITs to your portfolio, okay? Because unlike stocks who mainly they'll have quarterly dividends, that's every 3 months, or even as much as semi-annual or annual dividends. Unlike those, REITs pay out monthly dividends. This allows you to manage your portfolio more often, as well as take advantage of the increased compounding periods and reinvestments. The reason that REITs pay out these monthly dividends is because there's a few rules that REITs have to abide by in order to stay classified as a REIT. So in order to be considered a REIT can only own properties that are REIT eligible, okay? Number two, 75% of their income has to come from either rental income, mortgage interest, or capital gains from selling their properties, okay? But number three, here's the kicker. Here's what's the main difference between an ordinary dividend paying stock and a REIT. REITs have the benefit of receiving really good tax treatment from the government. So as long as they're paying out their income down to the unit holders, then they have to pay little, if any at all, taxes to the government. Now, it's because of this reason that REITs pay out 90 to 95% of their income down to the unit holders. And they don't just do this, okay? In fact, they're actually obligated to. So that's why it's really incentivizing to invest in REITs, because you get that exposure to the real estate market and your returns are pretty much 100% based on the rental income that these properties rake in. So it's kind of like you're a landlord from afar. Now, something I do want to highlight, okay, is the importance of tax implications when it comes to REITs, okay? And I'm not talking about the companies, I'm talking about for yourself. As REITs are a good investment for monthly cash flow, it's important to note that these payments aren't actually dividends, they're called distributions. And accordingly so, they differ from the ordinary eligible dividends that investors are used to. These distributions can consist of multiple sources of income, okay, including return on capital, capital gains, and either other foreign or non-business income. All these sources of income are taxed differently, and there's a lot of factors involved. So it's typically best to hold your REITs in a registered and tax advantage account as opposed to your non-registered or your cash accounts. All this helps to do is reduce headaches and hassles at the end of the year come tax reporting time. And so in Canada, you'll have your TFSA and your RRSP, and in the States, you'll also have your Roth IRA. Most of the time, you're going to benefit more, though, from holding your REITs in a TFSA as opposed to an RRSP, though, because the returns on REITs are more so from cash distributions opposed to return on capital. And return on capital is tax deferred, so you're really defeating the purpose of holding REITs in your RSP there. So my advice, buy your REITs, throw them in your TFSA, and leave them there as long as possible. Also, keep in mind, if you're buying US REITs, then you're subject to a 15% withholding tax on the dividends there. So that's on non-registered accounts as well as your TFSA. So you could actually benefit from holding US REITs in your RRSP, because in your RRSP, you are not subject to that tax. And so you're actually going to get the whole dividend there. If you want steady income as well as a good potential for growth, then REITs are going to be a good option to clump in your portfolio. You can generally find safe REITs that range from 3 to 4% up to 6, 7%, even 8 to 10% without taking on too much risk. I invest in quite a bit of REITs, but a couple of my favorites are the H&R REIT, so that's ticker symbol HR.UN. So this is a Toronto-based Canadian REIT that specializes in commercial properties. They're trading about $23 Canadian right now, and I've actually recently benefited from some price appreciation there as well, and they have a dividend yield of about 6%. Next, I would recommend RioCan, which is actually Canada's largest REIT. So they engage in the ownership, the development, and the operation of shopping centers, and currently they're trading at about a price of $26 Canadian, and they have a dividend yield of about 5.5%. Now, I'd also like to have an honorable mention for a very special REIT, and that is ticker symbol O, okay? And that's Realty Income Corp. This REIT is actually a dividend aristocrat, which means they've been known year over year to consistently make dividend payments as well as increase their payments every year. In fact, they have such an excellent track record that they've actually coined the trademark, the monthly dividend company. This year, they're celebrating 50 years of dividend payments, and that's a pretty big deal. So this REIT specializes in the rental segment. They have over 5,800 properties. That's a lot of properties with generally a long-term lease, so 10 to 20 years. And what this does is it helps secure their income well into the future. Now, it's important to note that Realty Income is a US REIT, okay? So it's listed on the New York Stock Exchange. So remember that if you're buying these, then you're going to be subject to that 15% withholding tax if held in any other account than an RRSP. But more importantly, this REIT is special because they're known to keep reinvesting into their business, okay? Expanding their portfolio, getting more properties. They're securing a lot of leases ahead of time, and they're even increasing their prices for rent. So they're currently trading at about a price of $70, that's US though, and they are paying a yield of about 3.7%. And lastly, if you don't want to pick individual REITs, you can also invest in a REIT ETF, okay? For example, ticker symbol XRE, which is the iShares REIT index. And you can get a very broad exposure there with the whole REIT market in just one fund. Now, this is where I'm going to tell you something very important, so listen carefully. As we've talked about in other videos regarding dividends, it's just as crucial here with REITs to understand that you shouldn't be out here chasing just a high dividend yield. Meaning that if you have a choice of two REITs, one paying 5% dividend yield and the other paying 9%, don't just go and buy the 9% because it has a higher yield. This should be obvious, but for some it's not, okay? Especially if you're new to the market, if you're just starting out. So just remember, you should be investing in good businesses, not yields, okay? So that means you're investing in companies that have good financials on paper, they have good management and a good value proposition. As we know, those who pay out higher dividend yields generally have less money at the end of the day to give back to themselves, to reinvest in the company and to grow. And you also need to be wary of debt, okay? How much debt a company is taking on. A lot of times a company can have a high dividend, but then, on paper, they're taking on a large amount of debt just to be able to make these payments. So it's really just ugly. It's not good. So for example, let's say you find a company, a REIT, that's paying a whopping 10%, 11%, 12% dividend yield, and you think you've hit it big. But in reality, okay, these companies tend to be largely leveraged, which means that they're extremely vulnerable to changes in interest rates. So say down the line, if there's a change to the interest rates, then these dividends could just be cut. Now, if this happens, then your return just went from 10, 11, 12% all the way to zero, okay? Not accounting for capital appreciation if you have any of that. Now, this is why I like a REIT, like Realty Income Corp, okay? Ticker symbol O. That is because they've been known year over year to not only just consistently pay their dividends, but to increase their dividends. And this really adds up over time. And on top of this, the price continues and continues to benefit from price appreciation, okay? So in the end, on paper, you're actually making a lot more than this 3.7% yield. And this proves to be the smarter investment choice over time because you're focusing on a good business, okay? You're not just out here chasing yields, which in the end could just mean nothing. So while we're still on the topic of Realty Income Corp, ticker symbol O, as the price continues to increase over time, it's been going for a while now, I'll always hear people talk about how it'll be smart to wait until a dip, okay? Or the price is too high now, yada yada. While I do partly agree with this, okay, it's often generally best to wait for little dips or corrections in the market to buy at a better price. At the same time, you don't want to punish winners for winning. A good company is a good company, okay? And you don't want to punish them just because they're doing well. We can't tell the future, okay? No one knows if there's going to be a dip with a company, if there's going to be a correction in that stock price at all even. So you might have, yes, a chance at having a better opportunity to buy in the future at a lower price. But at the same time, you're also just wasting all this time because your money's sitting on the sidelines, it's not being deployed, and then at the end of the day, when it's all said and done, the stock price could just be that much higher. So that's why dollar cost averaging is important. It's my advice to always be buying good companies that you have faith in regularly. And on top of this, it goes without saying, guys, you shouldn't be over allocating into REITs, okay? Don't just see this monthly dividend or these good yields and just think you're going to pile all your money in there, because like we talked about in other videos, you don't want to put all your eggs in one basket, okay? Sure, you're not investing into one company, but you got to remember this is an industry and it's the real estate industry, okay? So you got to plan ahead. Think if this market took a turn for the worst, okay? Then you could potentially be out all your money if you're just holding REITs. So my recommendation is to have maybe about 10% of your portfolio weight in REITs, even 20% as much as that if you really like REITs, but no more than that. So that brings us to the end of today's video. REITs really give you a good way to invest in real estate without having to manage it yourself. With interest rates being lower these days, many REITs have taken advantage of these low rates to refinance their mortgages while still charging high rates for their leases. What this does is essentially provides a hedge for investors against inflation in the future. They're good for cash flow as you receive monthly dividends, and there's also lots to choose from that have different payment dates, okay? So if you get a bunch of these different REITs, then it'll help to stagger your payment dates, which could increase your compounding in your portfolio. If you enjoyed this video, please hit that like button down below, smash that sub button if you want to stay in the loop, and hit the notifications bell if you want to get informed every time I drop a video. Go ahead and share this video with someone you really think could benefit from what we covered in today's video. If you have any questions or comments, leave those in the comment section below. What are your favorite REITs, okay? What do you like about REITs? What do you not like so much about REITs? And don't forget to follow me on Instagram at Boss Financial Channel. Hope I was able to teach you something today and maybe give you some motivation to go out there and start investing in the real estate market today. And as always, ladies and gentlemen, thanks for watching, stay positive, and see you next time.